Welcome to the Pro Ticker Deep Dive.
It is good to be back. And, looking at the sheer volume of data we have to get through today, I mean, the strategy notes, the earnings calls, these quantitative models, I think we are staring at perhaps the most confusing moment in the last 4 years of this market.
That is a big statement, a really big statement, considering what we've just lived through in 2024 and 2025. But I get it. I know exactly what you mean. We're sitting here, it's February 2026. And, the sun is shining, metaphorically speaking.
It is.
The market is entering year 4 of a bull run. Inflation seems to have finally, maybe, decided to behave itself. Growth is technically above trend.
Yeah.
It feels comfortable.
He feels comfortable. That's the word for it. It feels like that Goldilocks scenario that, everyone was promising us for years. Not too hot, not too cold.
Right.
Yeah.
Just right.
Yeah.
But there's always but on this show. I mean, otherwise we wouldn't have a show. You're telling me that this comfort is actually a warning sign.
I wouldn't call it a warning sign exactly. I'd call it a paradox, a real paradox. Because when you look at the surface, everything is calm, the water's smooth. But when you dig into the data, and specifically this incredible divergence between what the sentiment models are saying and what the fundamental analysts are saying, you start to get a vibe that I can only describe as uncomfortably bullish.
Uncomfortably bullish. I
the
love
hell?
that. It almost sounds like a medical condition. Doctor, I'm feeling uncomfortably bullish. Is there a pill for that?
It feels like one. And it just captures the tension of this moment of February 2026 perfectly. Think about it. Asset prices are near all-time highs. The consensus on Wall Street is tighter than it has been in a decade.
Everyone agrees.
Everyone agrees on what's going to happen. And yet, beneath that smooth surface, you have these structural cracks opening up in liquidity, in market breadth, and even in the physical power grid itself.
So, okay, here's our mission for this deep dive. We're going to peel back the layers of this so-called Goldilocks economy. We're going to decode a specific signal called a sell-side indicator, or SSI, which is flashing a number that seemingly contradicts everything the fundamental guys are saying.
It's a classic battle, really. It's the quants versus the humans, the
Yeah.
algorithm versus the analyst.
Exactly. And we're going to unpack why Wall Street is suffering from what you're calling a cluster problem and why that might be really dangerous for your portfolio. And then we're going to get very, very specific. We're going to look under the hood of 2 companies, Celestica and Microchip technology, that perfectly tell the story of the next phase of the AI economy. Not the hype phase, but the prove-it phase.
The plumbing and the power. That's really where the story is now.
But before we get to the plumbing, we have to look at the weather report. So let's talk about this sell-side indicator. I feel like this is one of those tools that people on Wall Street, they whisper about it, but normal people have no idea it even exists.
It's surprisingly effective, and it's actually quite simple in concept. I mean, even if the math behind it is, pretty complex.
Okay, so break it down for us.
Yeah.
What is the SSI actually measuring? What's going on there?
Okay, so imagine a survey. Bank of America tracks the recommended equity allocation of Wall Street strategists. So they go to the chief investment officers at the big banks, the pension funds, the big firms, and they ask a really simple question.
What's the question?
What percentage of a balanced portfolio should be in stocks right now versus, say, bonds or cash?
Okay, so it's a measure of how bullish the smart money is. If they say put 70% in stocks, they're obviously feeling bullish. If they say put 30%, they're bearish.
Yeah,
Simple enough.
Exactly. But, and this is the part that really twists people's brains, it is a contrarian indicator.
Okay, we need to stop there. We have to unpack contrarian.
Yeah.
Because in real life, if all the experts agree on something, usually you listen to them, right? If 9 out of 10 dentists say, use this toothpaste, I'm going to use the toothpaste. So why is the stock market different?
Because the stock market is a game of positioning. It's not just a game of opinion. So think about it this way. If every single strategist on Wall Street is euphoric, I mean, if they're all screaming, buy, 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 and telling their clients to be, 70% or 80% invested in stocks, what does that tell you about the cash that's on the sidelines?
Yeah.
Yeah.
It means there is no cash on the sidelines. It's already in the market. They've already bought everything.
Precisely. If everyone is already all in, there is no one left to buy. The buying power is completely exhausted. That is usually the top of the market. That is when the crash happens.
So when the party is loudest, that's exactly when the cops show up.
That is a perfect analogy. And conversely, when the strategists are absolutely miserable, when they're telling everyone to sell, to go to cash, to, hide under the bed, that is usually the bottom.
Why?
Because it means everyone who wanted to panic and sell has already sold. The only direction left is up.
Okay, so what we really want is for the experts to be depressed. That's our buy signal.
It's sad, but it's true. In the world of the SSI, misery is money.
So where are we right now? It's February 2026. The S&P has been absolutely ripping. The headlines are glowing. I have to assume the SSI is just flashing euphoria. Or, I mean, I'm picturing strategists dancing on the tables.
And that is the surprise. They aren't. As of the latest reading we have, the SSI is at 56.0%.
56%. Okay. Is that high? Is that low? Give me some context here.
It's neutral. It rose about 10 basis points in January, so it's the highest level since March of 2025. But the sell threshold, the real danger zone where we typically see market tops, is usually above 59% or 60%.
So we're sitting at 56%. We're in the middle. We're in no man's land.
We are in the neutral zone, but importantly, we are rising. And because we haven't hit that euphoria level yet, the algorithm is actually interpreting this as bullish.
Wow, so
It's saying, look, the market is up, but the strategists haven't completely lost their minds yet. They are not all in.
So there's still fuel in the tank. There's still buyers out there.
Exactly. Based on their historical regression, and we're talking about looking at data going back decades, a reading of 56% implies a 12% price return for the S&P 500 over the next 12 months.
Whoa. Hold on. 12%.
12%.
Are you serious?
That's percent.
12%. That is a massive number. I mean, we are already at all-time highs. If you tack another 12% onto the S&P 500 from where we are now, we're talking about the index pushing deep into the 7,000s.
Oh, yeah.
Maybe even touching 8,000, depending on the exact starting point.
Okay.
It sounds, I don't know, incredibly aggressive.
It would be a melt-up, a truly historic run.
But here is where I get confused, and I think the listeners might be confused here too. You just said the model predicts 12% upside, the computer. But I'm looking at the notes here regarding the fundamental analysts at the very same bank, Bank of America. And their official year-end target for 2026 is 70100.
Right.
So let me just do some quick napkin math here. 7,100 from where we are in late 2025, early 2026. That is barely a 4% gain.
It's a very modest gain. It's basically a rounding error compared to the kind of moves we've seen in the last few years.
So we have a conflict, a huge conflict. The sentiment computer is over here saying, we're going to the moon, 12% upside. And the human analysts are over there saying, maybe 4% if we're lucky. Who do we trust?
This is the defining tension of this entire deep dive. The model is looking at one thing, positioning. It's just saying people are still a little skeptical, therefore prices can rise. The fundamental team, the humans, they're looking at the mechanics.
What do you mean by mechanics?
They're looking at PE ratios of 22x, which is historically very expensive. They're looking at the Fed shrinking its balance sheet. They are looking at liquidity actually drying up. And they're saying the math just doesn't work for a massive rally. We can't support 8,000 on these fundamentals.
It feels like the market is trying to decide whether to follow its heart or its head.
Or perhaps whether to follow the crowd or the data. Which brings us right to the cluster problem.
Yes, the cluster problem. This really stood out to me. It sounds like something astronomers should worry about, like a cluster of stars colliding. But apparently it's a Wall Street problem.
Oh, it's a huge problem. It refers to the clustering of analyst forecasts. So usually at the start of a year, you have a really wide spread. You'll have the super bulls who think everything's going to be great and the super bears who are predicting a recession. And that spread creates a healthy market because you have buyers and sellers at every single price point.
That makes sense. Disagreement makes a market. If everyone thinks the price is wrong in different directions, they'll trade.
Exactly. But right now, the spread is tiny. I mean, incredibly small. The gap between the most bullish forecast on Wall Street, which I believe is Oppenheimer at 8,100, and the most bearish Stiefel at 7,000 is only about 16%.
16%. That's it. That seems, that's unbelievably narrow for a market that is this volatile.
It is the narrowest spread between the bull and the bear cases that we have seen in over a decade.
So everybody basically agrees. The story is stocks will go up a little bit or stocks will go up a medium amount. No one is saying crash, and no one is really saying rocket ship, except for this one SSI model.
Correct. And when everyone agrees like that, you should get nervous.
But why? Isn't consensus a good thing? It means things are stable. It means we have clarity,
yeah,
right?
It means things are fragile. Think about it like a crowded theater. If everyone is sitting calmly watching the movie expecting the same ending, that's fine. But if everyone is positioned for the exact same outcome, the soft landing, the Goldilocks scenario, then everyone is on the same side of the boat.
And if a rogue wave hits?
If something completely unexpected happens, a geopolitical shock, a sudden spike in inflation, a really bad earnings report from a major AI company, everyone tries to rush to the other side of the boat at the exact same time.
Chaos.
Because nobody was hedging for the bad outcome. That is how you get flash crashes. That is how you get these huge volatility explosions.
So this tight consensus is basically just a volatility coil that's being wound up waiting to spring.
It is. It's complacency disguised as stability. It has the effect of suppressing volatility in the short term, but it massively increases the risk of a violent, sharp move in the long term.
Okay, so what is this narrative? What is this story that everyone on Wall Street is hugging so tightly? What's the truth that they've all agreed on for 2026?
The story is the winner-takes-all economy.
That sounds ominous. It sounds like a reality TV show.
It kind of is, actually. The narrative is that the AI revolution is maturing. We're moving from the build-out phase of 2024 and 2025, which was just, everyone panic buying GPUs and digging holes for data centers, to the productivity phase.
The phase where you actually have to use all this expensive stuff to make some money.
Exactly. But the realization in 2026 is that the rewards of this productivity are not going to be shared equally. Not at all. We are seeing a massive concentration of power. The data refers to the AI 30.
The AI 30. That sounds like a club I can't get into.
Unless you're a trillion-dollar company, you definitely can't. These top 30 companies are expected to drive nearly 46% of all the earnings growth for the entire S&P 500.
Wait, stop. Did you say 46%?
Nearly half.
So you have 500 companies in the index, and 30 of them are doing almost half of the work. What are the other 470 companies doing?
They're watching, they're struggling, they are fighting for the scraps. Yeah. This is the winner-takes-all dynamic. It's very similar to the dot-com era in the late 90s, but honestly, it's even more extreme because of the capital requirements.
Right, because building an AI model isn't like building a website back in 1999. You could build a website in your garage with a credit card.
Exactly. To even play the game in 2026, you need data centers that cost billions of dollars. You need energy contracts that look like treaties between nation-states. Scale is the ultimate moat. If you are Microsoft or Google, you can self-fund all of this. You have the cash flow.
Right.
If you are a mid-sized software company, you can't compete. You just become a customer of the giants.
The big get bigger because only the big can afford to play the game.
Yeah.
That feels, I don't know, a little anti-competitive.
It's the nature of the technology. And this creates what they're calling a K-shaped reality. Not just for companies, but for the whole economy. That's another macro theme we have to touch on, the K-shaped consumer.
I've heard this term. The letter K has two arms, right? One goes up, one goes down.
It's the perfect visualization. The arm going up, that's the asset owners. If you own stocks, if you own real estate, you are doing great. Your net worth is probably at an all-time high because the market is up. You're spending money, you're traveling, you're buying the premium AI subscription without thinking twice.
And the arm going down.
That's the person who rents, the person who lives wage to wage. They don't own the assets that are inflating, but they do pay the prices that are inflating. They are getting squeezed by tariffs, by sticky inflation in services, by insurance costs.
So if you're an investor, you can't just say, oh, the consumer is strong.
No, you absolutely cannot. You have to ask which consumer. If you buy a stock that sells to the low-end consumer, let's say a discount retailer or a fast food chain, you might get crushed because your customer is completely broke.
But if you own the luxury brands,
if you buy a stock that sells luxury goods or enterprise software to the winners, you win.
Selectivity. That seems to be the word of the day.
Selectivity is the key word for 2026. You cannot just buy the index and go to sleep. You have to pick your spots very, very carefully.
Which brings us to the other massive constraint on this winner-takes-all economy. We talked about money being a constraint, but there's a physical constraint too, isn't there?
The power problem.
I feel like for the last few years, we all thought AI lived in the cloud. And the cloud sounds so fluffy, it sounds weightless, it sounds infinite.
It was a great marketing term, but the cloud is actually a giant concrete building full of hot silicon that is just screaming for electricity. And in 2026, we are hitting the wall.
The grid just can't take it.
The grid is struggling. I mean, we are talking about data centers that consume as much power as a small city. The demand for power, and not just any power, but firm, reliable 2247 power, is colliding with a grid that in many places hasn't been significantly upgraded in 40 years.
And this is why we're suddenly seeing all this talk about nuclear again.
Nuclear, natural gas, copper, grid modernization. One of the reports we looked at calls it the security supercycle.
That's an interesting way to frame it. Security. Usually that means tanks and missiles.
Because it's all linked now.
Yeah.
Energy security is national security. If you can't power your AI, you lose the technological arms race. If you lose the tech race, you lose the defense race. So you're seeing governments and these hyperscalers treating electricity not just as a utility anymore, but as a strategic asset.
Sovereign AI. I've seen that term. Every country wants its own brain, and it needs its own power plant to run it.
Precisely. So when we look for investment ideas, which we're about to do, we have to look for the companies that are solving these very real physical problems. We need the companies that build the infrastructure to move the data and the companies that help manage the power more efficiently.
The picks and shovels.
Mm.
Or maybe in this case, the wires and switches.
The wires, the switches, and the gate drivers.
Okay, that is the perfect setup. So we have a market that is technically bullish, but incredibly concentrated. We have a sentiment model predicting a melt-up, while the human analysts are warning of a ceiling. And we have a physical world that is struggling to keep up with all this digital demand.
That is the chessboard.
So let's make a move. Let's talk about our first deep dive stock. This is a company that I'll admit I hadn't really thought about in years. I kind of thought of them as an old school manufacturer, but apparently they are the plumber of the AI age. Celestica, ticker CLS.
Celestica is such a fascinating case study because they are the absolute anti-hype stock. If you look at NVIDIA, it's glamorous, it's the brain. Celestica, they're the nervous system. They're a manufacturing solutions provider.
Manufacturing solutions provider. You're really trying to sell this to me. That has to be the most boring business description in history. Sounds like they make cardboard boxes.
I know, it sounds incredibly dry, but you have to understand what they are actually building. And to do that, we need to talk about the white box revolution.
Okay, I've seen this term in the notes. White box. It sounds like generic cereal from the grocery store.
That is actually a great analogy. Think about the old way of building a network, say 10 years ago. If you were a big company, you bought a switch from Cisco or from Juniper. It was a black box.
Meaning what?
Meaning it was proprietary. You bought their hardware, you had to use their software, their operating system. It was expensive, very high margin, and you were completely locked in. It's like buying a Mac. Use Mac OS, whether you like it or not.
Got it. High quality, but you have to play by their rules.
Right. But now look at the hyperscalers. Google, Amazon, Meta. Do they want to use Cisco software? No. They have thousands of the smartest software engineers in the world. They write their own code. They don't want to pay for the brand name. They just want the raw, high-performance metal.
They want the generic cereal because they're going to add their own milk and fruit and sugar anyway?
Exactly. They want a white box, a switch that is unbranded, completely open, and purely designed for one thing: speed. And they need these switches to be incredibly fast. We're talking 800 gigabit, 1.6 terabit speeds.
Because these AI models are just huge.
They're massive. When you train a model like GPT-5 or whatever comes next, you are splitting the work across thousands and thousands of chips. Those chips need to talk to each other constantly. If the switch is slow, the chips have to wait. If the chips wait, you are literally burning money.
So the switch is the bottleneck.
The switch is the critical path. And Celestica has positioned itself as the leader in manufacturing these incredibly high-end, complex white box switches for the hyperscalers.
They're not just bending metal. This is very high-precision engineering we're talking about.
It is, and the numbers absolutely prove it. I want to highlight one specific metric from the Bank of America report that just blew my mind. Their return on equity, their ROE.
Okay, so for the non-finance nerds listening, ROE is basically how efficient the company is at generating profit from the money that shareholders have put into it.
Correct. For a typical hardware manufacturer, a company that owns factories, buys inventory, hires assembly workers, an ROE of 10% or 12% is pretty decent. 15% is great. Celestica's ROE is over 30%.
30%. That's software territory. That's like a tech platform number, not a factory number.
Yeah.
How on earth are they doing that?
It is unheard of in this sector. It tells you that they are running an incredibly tight ship. They aren't just a contract manufacturer anymore. They're a value-added partner. They're helping design these things. They're efficient. And they have pricing power because what they make is really, really hard to replicate.
And the analysts are definitely noticing. BofA initiated coverage with a buy and a $400 price target.
Which is a bold call. And they recently raised their fiscal year 2026 EPS guidance to $8.75. You know, the consensus, the average guess on Wall Street was only around $8.17.
So they didn't just beat the number, they smashed it. They blew it out of the water.
They smashed it. They are projecting $17 billion in revenue. But, and here's where the drama comes in, It hasn't been a straight lineup for the stock. Did you catch the Google scare in the notes?
I did. This felt like a real soap opera moment.
Yeah.
You know, will they or won't they break up?
It was pure market gossip. So a report came out, I believe it was from Digitimes, suggesting that Google, which is Celestica's biggest customer for this stuff, might be shifting some of its TPU manufacturing to a competitor called Inventec.
And TPU is the tensor processing unit. That's Google's own AI chip.
You're right. And for Celestica, Google is the whale. Losing Google would be catastrophic.
So the market panicked.
The market panicked, the stock took a big hit, the fear was, okay, the party is over, Google is cheating on them.
But was it actually true?
Well, this is where RBC Capital, another major bank, stepped in to play referee. Their analysts did the channel checks, they called the suppliers, and they basically concluded, calm down.
Calm down is pretty good advice in general.
Their analysis is that Celestica retains the bulk of the volume. Yes, Google might give some secondary business to Inventec. That's normal. You never want to rely 100% on one factory. It's just basic supply chain management. But Celestica is still the primary partner.
So the market freaked out over a rumor, creating what might be a buying opportunity for a company that is printing money with 30% ROE.
That is the bull case. It is a pure play on infrastructure. It doesn't matter if ChatGPT wins or Gemini wins or if Elon Musk's AI wins. They all need switches. They all need the plumbing. Celestica sells the pipes.
I love a good picks and shovels play. It just feels safer than betting on the magic software. But speaking of safety, let's pivot. We talked about the new economy, this AI infrastructure. I want to talk about the old economy, the cyclical stuff. Because our second stock, Microchip technology, seems to be telling a completely different story.
It is. If Celestica is about hypergrowth, Microchip is about resilience and recovery. This is a total turnaround story.
Okay, so set the scene for us. Why do they need a turnaround? What happened?
To understand Microchip, you have to understand the disaster that was 2024 and 2025 for the entire analog chip market.
Disaster is a strong word.
I think it's accurate. Think back to the pandemic. Everyone couldn't get chips. Ford couldn't build cars. Washing machines were backordered for months. So what did every company in the world do?
They ordered double. They hoarded them. They panic bought chips like it was toilet paper.
Exactly. They filled their warehouses to the ceiling with chips. Then, in 2024, the economy slowed down, interest rates were high, and suddenly these companies looked at their warehouses and said, oh my God, we have enough chips to last for 2 years.
So they stopped buying, just cold turkey.
Cold turkey. Sales for companies like Microchip fell off a cliff. It was a classic inventory glut. Economists call it the bullwhip effect. A small change in demand causes this massive, violent swing in supply orders.
But now, here in February 2026, you're saying the warehouse is finally empty. They've used up all the toilet paper.
The signal is flashing. The slump is ending.
How do we know that? Is it just a vibe? Or is it actually in the numbers?
Oh, it's in the numbers. Look at their Q4 earnings. Revenue was $1.19 billion. That's up 15.6% year over year.
That's a pretty healthy bounce.
It's a confirmation. It means the customers have finally worked through that mountain of old inventory and they are placing new orders again. Supply and demand have realigned.
Okay, so the business is stabilized. But why is it exciting? Microchip. I mean, the name even sounds small. Micro. What do they actually make?
They make what they call the intelligent edge, which is, marketing speak for. They make the chips that go into boring things to make them smart.
Give me an example of a boring thing.
An industrial robot arm, a charging station for an electric car, an HVAC system in a skyscraper, a washing machine. These aren't supercomputers, but they need to process data locally. They need to handle power. And that is where Microchip shines. Specifically, their new 600-volt gate driver family.
Okay, you're getting technical on me again. 600-volt gate driver. Why do I, as a regular person, care about a gate driver?
You care because you hate waiting for your EV to charge.
That is true.
And you care because you want your electricity bill to be lower. Think of a gate driver like a really, really high-state faucet. It controls the flow of electricity from the battery to the motor or from the wall to the battery.
Okay, like a valve.
A valve that opens and closes millions of times a second. If that valve is inefficient, you lose a ton of energy as heat. If it's efficient, like this new 600-volt family, you get faster charging, better range, and less wasted energy.
So as the whole world tries to electrify, and this goes back to that power theme we discussed, Microchip is selling the essential components that make it all possible.
Exactly. They are right in the center of the electrification trend. And Wall Street loves this setup. You have the cyclical recovery sales bouncing back, plus a secular growth story with EVs and industrial automation. You saw BOFO went to buy with a $95 target. Argus went to strong buy.
It sounds perfect. Everyone loves a comeback kid.
It does sound perfect.
But
However,
comes a however.
I knew there was a catch.
There is a flag on the play. A big red flag.
I saw this in the notes. The insider selling. It's very hard to ignore. The CEO, Steve Sanghi, he's a legend in the industry, really. But he recently sold about 98,000 shares of his own company's stock.
A lot of shares.
It's worth nearly $8 million. And it wasn't just him. The CFO sold shares, too.
Okay, let's play devil's advocate here. If I'm the CEO and I know my company's about to rocket to the moon because of these amazing new 600-volt chips, why am I cashing out $8 million right now? That feels like a serious lack of confidence.
It is the ultimate uncomfortable question. It creates this huge tension because the analysts are all screaming, buy, 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 and the guy who is actually running the company is hitting the sell button.
Is there an innocent explanation? There has to be one, right?
There usually is. I mean, executives sell for many reasons: diversification, buying a house, tax planning. Sanghi still owns millions of shares. It's not like he liquidated his entire position. He's still very heavily invested, but it's never a great look.
It's just bad optics.
It is. And then there's the financial engineering aspect of it. They're issuing a convertible note.
For $600 million. For the listeners who don't spend their lives in finance, can you explain why a convertible note might be seen as a negative?
So a convertible note is basically a form of debt that can be converted into stock later on. In the short term, it can dilute existing shareholders, meaning your slice of the pie gets smaller. That's usually bad for the stock price immediately.
So why do it then?
To raise cash. They're raising $600 million.
To do what?
To fund growth, to build factories,
Right.
to invest in R&D for those new 600-volt chips. So the expert view here, the optimistic view, is that the fundamentals, the revenue growth, the end of the slump, that all outweighs the insider selling and the dilution risks. They are raising money to grow, not just to survive.
But it requires a stronger stomach than Celestica. Celestica feels clean. Microchip feels messy.
Celestica is the efficiency machine. Microchip is the recovery bet with a side of management caution.
Okay, so we've looked at the good stuff. We've looked at the 12% upside, the infrastructure plays, the recovery plays. Now, I want to talk about the things that could go wrong. Because this report we're analyzing isn't just sunshine and rainbows. There's a big section on risks. And they use a term that really stuck with me.
The air pocket.
The AI air pocket. It's such a vivid image, it makes me want to fasten my seatbelt.
It should.
What does it mean? Are they saying we're going to crash?
Not a crash, not a bubble bursting. Think of it more like turbulence on a flight. You drop altitude suddenly, it feels scary, your stomach drops, but the plane is still flying. The risk comes from the gap between CapEx and monetization.
Spending versus earning.
Exactly. Companies like Microsoft, Google, Meta, they are spending hundreds of billions of dollars on chips and data centers. That is the CapEx. We know they're spending it. We can see the receipts.
But are they actually making money from it?
That is the trillion-dollar question. Investors are starting to ask, where is the profit from all this? We have cool chatbots, sure, but is it moving the bottom line enough to justify $1 trillion of spending?
And if the answer is not yet.
If the profits don't show up fast enough, the market might get very impatient. The hyperscalers themselves might say, whoa, let's pause the spending for a quarter. Let's just digest what we've already bought.
And if that spending pauses.
Then the whole AI trade hits an air pocket. NVIDIA, Celestica, all of them. They could drop 20% in a week until the earnings catch up to the hype.
And this isn't happening in a vacuum, right? It's happening at the same time that liquidity is drying up.
This is the second major risk. BofA argues that the market's fuel is running low.
This is the quantitative tightening part, the Fed's actions.
The Fed balance sheet has shrunk from a peak of $9 trillion down to $6.6 trillion. That is over $2 trillion of liquidity that has been pulled out of the system. That's money that used to be sloshing around looking for a home in stocks or bonds, and it's just gone.
And on top of that, buybacks are slowing down too, right? Usually, companies prop up their own stocks by buying back their own shares.
Significantly. Buybacks were down 20% quarter over quarter in Q2 of 2025.
Why is that?
Because they're spending their cash on AI chips. They can't afford to buy back their stock because they have to buy GPUs from NVIDIA just to stay relevant.
So less money floating around from the Fed, less money coming from corporate buybacks.
Which implies that the market is running on thinner ice than it appears. It requires earnings to do all the heavy lifting now because the liquidity tide is going out.
And meanwhile, valuations are, well, they're rich.
Expensive. The S&P 500 forward PE is at 22x. That matches the 2021 peak. It's getting very close to the 2000 peak.
Ouch. 2000 and 2021 were not exactly great times to go all in on the market.
They were not. Goldman Sachs points this out too. They say high valuations increase the magnitude of the downside if earnings happen to disappoint.
So basically, if you are priced for perfection, you better be perfect.
Exactly. If you're priced at 22 times earnings, you can't miss your revenue target by even a penny. If you do, the market punishes you severely.
And that brings us all the way back to that tightness in the analyst forecasts, that cluster problem. If everyone expects perfection, and what we get is a pretty good year, the market could punish pretty good, as if it were a disaster.
That is the danger. Complacency meets high valuation meets low liquidity. It's a fragile combination.
So what does this all mean for the listener? We've covered a lot of ground here. We have the SSI saying buy because strategists aren't euphoric, yeah? We have the fundamental targets saying hold because the math is stretched. And we have specific stocks showing massive growth, but also some, insider jitters.
I think the synthesis here, the big takeaway, is that 2026 is the year of selectivity.
The rising tide isn't going to lift all the boats anymore.
No. The index might grind higher, maybe that 4% to 7,100, maybe even the 12% upside if sentiment really improves. But the real action is under the surface. The winner-takes-all dynamic favors high-quality, cash-rich companies. The AI 30...
And the companies building the actual stuff, the physical things.
Right. Infrastructure. Celestica represents that tangible build-out. You can kick the tires on a switch. Microchip represents the cyclical recovery of the industrial economy. These are two different ways to play the upside that aren't just buy NVIDIA and pray.
It feels like we are graduating from the hype phase of this bull market to the prove-it phase.
That is the perfect way to describe it. Show me the cash flow. Show me the ROE. Show me that you can survive if and when the air pocket hits.
Before we wrap up, I want to leave the listeners with one final thought. We talked about the SSI predicting a 12% rally. We talked about liquidity drying up. We talked about insiders selling.
It really does raise a provocative question.
If the sell-side indicator is right and we get this final melt-up, this 12% rally, but the liquidity tank is empty and the CEOs are selling, who is left holding the bag at the top?
Is this the final squeeze before the air pocket hits?
That is the question I'm going to be asking myself looking at my portfolio tonight. Are you holding the builders, the infrastructure, the real value, or are you just holding the hype?
It's time to check your holdings.
Absolutely. Thank you for guiding us through this maze today.
Always a pleasure.
And thank you for listening to the Pro Ticker Deep Dive.
Yeah.
See you next time.